All right, so let's dive into something I think we can all relate to. The desire to make money in the stock market.
Yeah.
Without having to constantly check our portfolios, right? Who doesn't love that idea of steady growth
Right.
and maybe a little extra cash flow along the way?
Absolutely. You're hitting on a universal desire there, for
Yeah.
sure. And for a lot of investors, that's where the appeal of these blue chip dividend stocks comes in.
Yep.
These are those well-established companies, the household names that have a history of paying dividends.
Right.
And importantly, increasing those dividends over time.
Okay, that makes sense.
Yeah.
But I mean, the market is a wild beast.
Yeah.
How does that translate into a less stressful investing experience
Yeah.
for someone like me who's maybe a little more risk averse?
That's where this idea of finding an undervalued company comes into play.
Okay.
Even the most reliable companies can be momentarily affected by, just kind of market fears.
Mm-hmm.
And that's when a savvy investor might see a buying opportunity.
And that's what today's deep dive is all about, right?
Exactly.
We're looking at an article called The Smartest Dividend Stocks to Buy with $500 right now.
Yep.
And just to give you a taste, we're talking about companies like AbbVie, PepsiCo, and Hershey.
Exactly. And I think these picks are particularly interesting for someone like you, looking for stability, but
Right.
also the potential for growth.
Okay, sign me up. Let's start with AbbVie.
All right.
When I hear pharmaceutical company, I immediately think government regulation.
Yeah.
Is that the market fear we're talking about here?
Yeah, you're right. There's been a lot of talk about potential changes in the pharmaceutical industry's, regulatory landscape, and that's spooked some investors.
I get that change can be scary.
Yeah,
But AbbVie is a spinoff from Abbott Labs, which has a long history of success, right?
absolutely. In fact, AbbVie has earned the title of Dividend King,
Oh, wow.
meaning they've consistently increased their dividends for at least 50 consecutive years.
Yeah, okay.
But what makes this even more interesting is their portfolio.
Oh, yeah, they've got Botox. I
Right.
mean, who hasn't heard of Botox?
Exactly.
But honestly, beyond that, what else is driving their success?
Well, Botox is definitely a well-known product, but their immunology drugs,
Yep.
Skyrizi and Rinvoq, are actually experiencing incredible growth.
Okay.
They're really a powerhouse in that sector.
So they've got a strong track record,
Yeah.
a diverse portfolio.
Yeah.
But how does that translate to potential returns for an investor?
Okay.
Help me connect the dots here.
So let's look at their dividend payout ratio,
Okay.
which is projected to be about 56% of their 2024 earnings.
Okay.
Essentially, that means they're only paying out a little over half of their profits as dividends,
Right.
leaving plenty of room for future increases and reinvestment in their business.
Okay, so a lower payout ratio is a good thing
Yes.
because it shows they can sustain and even grow those dividends over time,
Exactly.
even if they hit a rough patch.
Exactly. And it's not just the dividends analyst project that their earnings will grow about 8% annually over the next few years.
That's impressive. But
Yeah.
what about the actual price of the stock?
Well, that's where it gets even more interesting.
Okay.
AbbVie's forward price to earnings ratio, or forward PE,
Great.
is currently under 15.
Hold on, back up for a second. Forward PE.
Yeah.
What does that even mean, and why
Right.
should I care?
It's a key metric that investors use to gauge a company's valuation.
Okay.
It essentially compares the current stock price to the projected earnings per share for the next year. A lower forward PE, especially compared to industry averages or a company's own historical PE,
Right.
can suggest that the stock is undervalued.
So if AbbVie's forward PE is under 15
Right.
and they're expected to grow at 8%,
Yeah.
does that mean the stock price has room to grow as well?
Potentially, yes.
Yeah.
And when you factor in their dividend yield of 3.5%, which is the annual dividend payment, as a percentage of the stock price, you start to see a pretty compelling picture.
Okay, I'm seeing the potential here. Steady growth dividends.
Yeah.
And maybe even some stock price appreciation.
Right.
But what about PepsiCo? What's the market fear surrounding them?
So PepsiCo, like AbbVie,
Right.
is actually facing concerns related to potential regulations, though
Right.
in a different realm.
Okay.
There are worries about how political climates might impact their global operations.
Mhm.
And interestingly, there's also buzz around the potential impact of new weight loss drugs,
Yeah.
like GLP-1 agonists
Okay,
on
right there.
beverage consumption.
GLP-1 agonists. Can you unpack that a little bit?
Sure.
I'm familiar with traditional weight loss methods,
Right.
but this sounds more like a medical approach.
Yeah, you're right. They are medications.
Okay.
GLP-1 agonists work by mimicking a hormone in your body that
Yeah.
helps regulate blood sugar and appetite.
Okay.
So unlike traditional methods that focus on, calorie restriction or increase exercise.
Right. GLP-1 agonists actually target the biological pathways that control hunger and fullness.
That's pretty fascinating.
Yeah.
So the market is essentially worried that people will drink less soda
Yeah.
if they're taking these drugs.
That's one of the concerns, yes. And while PepsiCo did see a slight dip in sales recently,
Okay.
I wouldn't necessarily hit the panic button just yet.
I'm with you. I remember making rash investment decisions
Yeah.
based on short-term news. How do you, as an
Yeah.
expert, avoid getting swept up in that kind of market frenzy?
It's all about taking a long-term perspective and looking beyond the headlines.
Okay.
PepsiCo's brand portfolio is incredibly strong.
Yeah.
You know, we're talking about iconic brands like Pepsi, Gatorade, Mountain Dew.
Right.
I mean, it's hard to imagine them just disappearing from our shelves.
Yeah. Those are definitely household names.
Right.
But what about this shift towards healthier options?
Right.
Does PepsiCo have a play in that space?
Absolutely.
Yeah.
In fact, they've been strategically moving in that direction for a while now.
They recently acquired Seedit Foods, a company known for its healthier, grain-free, Mexican-American-inspired foods for a cool $1.2 billion.
Wow. That's a significant investment. So they're not just sitting back and watching the market change around them.
Right.
They're actively adapting.
Exactly. And that's a quality you want to see in any company you're considering for the long term.
Okay, so we've got a company with a history of dividend growth,
Yeah.
a diverse portfolio,
Yep.
and they're adapting to evolving consumer preferences.
Uh-huh.
Where do their valuations stand in all of this?
Well, PepsiCo is currently trading at a forward PE of under 18.
Okay.
And here's the kicker. Their dividend yield is 3.55%,
Okay.
which is the highest it's been in a decade.
Wow.
Except for a brief period during the 2020 market crash.
So if I'm understanding this correctly,
Yeah.
the market is undervaluing PepsiCo despite their strong fundamentals
Yeah.
and proactive approach to changing trends.
That's one interpretation. Yes. And it's what makes them a potentially compelling investment
All right.
for those who believe in their long-term potential.
All right, let's move on to our final company for this part of our deep dive.
Okay.
Hershey. I have to admit, this one brings back some childhood memories.
Who doesn't love chocolate, right? But behind those sweet memories,
Right.
Hershey is facing some unique challenges.
Okay.
The global cocoa shortage has driven prices way up,
Oh, wow.
which is putting pressure on their business.
Sounds a bit daunting. I can imagine those price increases impacting their bottom line.
Yeah.
But chocolate is such a staple. Is the market overreacting?
It's definitely something to consider. You know, the enduring appeal of chocolate and candy suggests long-term stability for Hershey.
Right.
However, the global cocoa market is complex, and those rising prices, could signal long-term volatility.
Okay, I see both sides of the coin here.
Yeah.
But remind me, what are we looking for as investors?
Right.
What metrics should we be paying attention to?
So when evaluating a company like Hershey, especially in a volatile market, it's essential to look at a variety of factors.
Yeah.
We've discussed PE ratios and dividend yields, but another crucial metric is return on invested capital,
Okay.
or ROIC.
ROIC. Break that down for me.
Yeah.
How does that help me understand Hershey's situation?
Essentially, ROIC measures how effectively a company is using its capital to generate profits.
Okay.
It's a measure of their efficiency and profitability. And Hershey has an impressive ROIC of 21.6%,
Okay.
which means they're generating a solid return on their investments,
Okay.
even amidst these cocoa price challenges.
So even though they're facing this external pressure,
Yeah,
they're still managing to make money and use their resources effectively.
exactly. And that's a good sign for their ability to weather this storm and continue to generate value for shareholders.
Okay. I'm starting to see the bigger picture here. High ROIC,
Yeah.
established brands. Anything else I should be considering?
Well, let's not forget about their dividend history.
Right.
Hershey has increased their dividend for 15 consecutive years now,
Wow.
and their current payout ratio is a healthy 60%.
Okay, so they're consistently returning value to shareholders through dividends,
Right.
and they have a strong track record of managing their finances.
Yeah.
But how does that translate to their current valuation?
That's where it gets interesting. Hershey is currently trading at a PE ratio,
Okay.
slightly below 21,
But
which is significantly lower than their 10-year average of 27.5.
Hold on. A lower PE ratio than their historical average.
Yeah.
Isn't that a good thing?
Yeah.
Does that mean the market is undervaluing them?
It could, yes. It suggests that the market might be overly focused on the short-term challenges
Okay.
and discounting their long-term potential. Now, it's important to remember that past performance doesn't guarantee future results,
Right.
but it does give us some context for how the market has valued Hershey historically.
This is fascinating. We've covered 3 very different companies facing unique challenges, but they all seem to have this underlying theme of being potentially undervalued by the market.
Exactly.
I'm really starting to understand the appeal of looking for these kinds of opportunities.
It's all about separating the signal from the noise.
Right.
Sometimes those short-term fears create opportunities for patient investors who are willing to look beyond the headlines
Right.
and understand a company's true potential.
All right, let's take a pause here and come back to explore these companies even further in part 2.
Sounds good.
Welcome back to the deep dive. We're unpacking some interesting companies that might just be diamonds in the rough.
Yeah.
Those potentially undervalued dividend stocks with a lot to offer.
It's like we're on a treasure hunt, right? Searching for those hidden gems
Right.
that the market might be overlooking.
Exactly. We're not shying away from those companies facing challenges.
Yeah,
In fact, that's where the real opportunities might lie.
absolutely.
We were just talking about AbbVie and their potential regulatory hurdles. I'm curious, what specifically our investors worry about?
Well, there's been a lot of discussion about potential drug pricing regulations.
Okay.
Governments around the world are looking for ways to lower healthcare costs.
Right.
And pharmaceutical companies are often in the crosshairs.
Okay, that makes sense.
Hmm.
Lower drug prices would be great for consumers,
Yeah,
but I can see how that would make investors nervous.
right.
But didn't you say that AbbVie has a pretty impressive track record?
They do. They've navigated regulatory challenges before, and they've consistently delivered, strong returns for their shareholders.
Right.
And let's not forget, they have a robust pipeline of new drugs in development,
Okay.
which could help offset any potential pricing pressures.
So it's not just about their existing portfolio.
Yeah.
It's about their ability to innovate and bring new products to market.
Right.
That makes me feel more confident about their long-term prospects.
Yeah, innovation is key in any industry, but especially in pharmaceuticals,
Right.
where patents expire and competition is fierce.
Speaking of competition, let's talk about PepsiCo. They're facing that double whammy
Yeah.
of political uncertainty and potential disruption from those GLP-1 agonists we discussed earlier.
Right.
I admit I'm still wrapping my head around how those drugs could impact the beverage industry.
It's a fascinating development, and it highlights how scientific advancements can have ripple effects
Right.
across seemingly unrelated industries. Think about it. If people are feeling less hungry and more satiated because of these medications, it stands to reason that they might consume fewer sugary drinks.
Okay, that logic tracks.
Yeah.
But I'm also thinking about those iconic PepsiCo brands you mentioned earlier.
Right.
Surely those brands have some staying power, right?
Absolutely.
People aren't going to just stop drinking Pepsi overnight, are they?
Brand loyalty is a powerful force, and PepsiCo has cultivated some of the most recognizable brands in the world.
Right.
But, they're not relying solely on nostalgia. Remember that acquisition of Seat Foods we discussed?
Yeah.
That's a strategic move to capture a share of that growing market
Okay.
for healthier snacks and beverages.
That's right. They're adapting to changing consumer preferences.
Exactly.
So while those GLP-1 agonists might pose a challenge in the beverage sector,
Yeah,
PepsiCo is diversifying and evolving.
exactly. They're not just a beverage company anymore.
Mm-hmm.
They're a food and beverage powerhouse with a portfolio that spans a wide range
Right.
of consumer needs and desires.
So they're hedging their bets, so to speak,
Right.
by expanding into different areas. That makes me feel more confident
Yep.
about their ability to navigate these potential headwinds.
Uh-huh.
But what about their valuation? Are they still an attractive investment,
Right.
considering all these factors?
Well, as we discussed, they're currently trading at a forward PE ratio of under 18,
Okay.
which is quite reasonable,
Mm-hmm.
especially when you consider their dividend yield of 3.55%.
I'm really starting to understand the appeal of those dividend yields.
Yeah.
It's like getting paid to wait for the stock to appreciate.
Exactly.
But let's move on to Hershey. They're facing those skyrocketing cocoa prices,
Right.
which seems like a pretty significant challenge.
Yeah, it's a tough situation for sure. The
Wow.
global cocoa market is complex
Right.
and a confluence of factors,
That's right.
including weather patterns, political instability,
Oh, wow.
and even disease outbreaks can impact supply and prices.
Wow.
Hershey, like any other company that relies heavily on cocoa,
Right.
has to find ways to manage those costs.
I imagine they probably had to raise prices, right?
Mm-hmm.
Has that impacted consumer demand?
They have increased prices, yes.
Okay.
And while price increases can sometimes lead to a decrease in demand,
Right.
Hershey has managed to navigate this carefully.
Okay.
They've been strategic in their pricing strategies, and they've also focused on innovation, introducing new products and flavors to keep consumers engaged.
So it's a balancing act between managing costs,
Yeah.
maintaining margins, and keeping consumers happy.
Right.
It sounds like they're walking a tightrope.
It is a delicate balance.
But didn't you say that their return on invested capital, that ROIC, was pretty impressive?
It is. Their ROIC of 21.6% indicates that they're very efficient
Okay.
at generating profits from their investments,
Right.
even in the face of rising input costs.
Mm-hmm.
This suggests they have a strong management team that knows how to allocate resources effectively.
That's reassuring.
Mm-hmm.
But let's be realistic. Chocolate is a luxury.
Yeah.
In a tough economy, do people really prioritize spending on chocolate?
Right.
I'm wondering if that's a factor in their current valuation.
That's a valid point. Consumer spending patterns can definitely shift during economic downturns.
Right.
However, Hershey has a long history of weathering economic storms.
Okay.
They've been around for over a century.
Right.
And they've seen their fair share of recessions, wars, and other global crises.
So they have that resilience factor. They've been through tough times before, and they've come out the other side.
Exactly.
That speaks to their brand strength and their ability to adapt.
Absolutely. And let's not forget about their dividend history.
Okay.
They've increased their dividend for 15 consecutive years.
Wow.
Which is a testament to their commitment to returning value to shareholders, even during challenging times.
Okay, so we've got a company with a strong track record, a history of innovation, and a commitment to shareholder value through dividends.
Right.
What's their current valuation telling us?
Well, as we discussed earlier, their PE ratio is currently below their historical average,
Right.
which suggests that the market might be undervaluing them.
Okay.
Now, it's important to remember that valuation is just one piece of the puzzle.
Mm-hmm.
We need to consider all the other factors we've discussed.
Right.
Their management team, their brand strength, their ability to innovate.
Their dividend history to get a complete picture.
This is so much more nuanced than just looking at a stock chart or a single metric.
Right.
I'm really starting to appreciate the depth of analysis that goes into evaluating these companies.
That's multifaceted.
But what about the bigger picture? What are the common threads we're seeing
Yeah.
across these three seemingly different companies?
Well, one common thread is that they're all operating in industries
Okay.
that are facing some degree of disruption or uncertainty.
Okay.
We've got healthcare with AbbVie navigating potential regulatory changes.
Right.
Consumer goods with PepsiCo adapting to evolving consumer preferences and the potential impact of new weight loss drugs.
Right.
And the chocolate industry with Hershey grappling with those volatile cocoa prices.
So it's not just about finding companies in safe industries.
Right.
It's about understanding how those industries are evolving.
Exactly.
And finding companies that are well-positioned
Right.
to adapt and thrive in those changing landscapes.
And another common thread is that all three of these companies have a history of dividend growth.
Right.
Which suggests that they have a strong track record of generating profits and returning value to shareholders.
Exactly.
Okay, so we've got companies in evolving industries with a history of dividend growth. Anything else?
Well, perhaps the most important common thread
Right.
is that they're all currently trading at valuations that suggest they might be undervalued by the market.
Okay.
Now, this doesn't necessarily mean they're guaranteed to be great investments,
Right.
but it does make them worth a closer look.
It's like they're flashing a giant potential opportunity sign.
Yeah, exactly.
But before we get too excited, let's take a pause here.
Okay.
And come back to discuss the key takeaways and what all of this means for our listeners in part 3.
Sounds good.
Welcome back to the Deep Dive. We've been exploring those potentially undervalued dividend stocks.
Yeah.
AbbVie, PepsiCo, and Hershey.
Right.
Companies that are facing some challenges. Yes, but also showing real signs of strength and resilience.
It's been a fascinating journey, hasn't it? We've dug into their financials, their strategies, and even how they're responding to these, shifting industry landscapes.
It's been eye-opening for sure. But I think what's really resonated with me is this idea of looking beyond the headlines, of not letting those short-term fears dictate my investment decisions.
That's a crucial mindset for any investor, especially those who are, in it for the long haul.
Right.
The market is a fickle beast, and it's easy to get swept up in the, emotional roller coaster.
I've definitely been there.
Yeah.
But I'm curious, as we wrap up this deep dive,
Yeah.
what are some of the key takeaways that our listeners, those learners out there,
Right.
should keep in mind as they evaluate these companies or any other investment opportunity for that matter?
Well, first and foremost, I think it's important to remember that investing is a personal journey.
Okay.
There's no one-size-fits-all approach. What might be a great investment for one person might not be suitable for another.
Mm-hmm. It all comes down to your individual goals, your risk tolerance, and your investment philosophy.
Okay, so it's not just about blindly following someone else's recommendations.
Right.
It's about understanding yourself as an investor.
Exactly.
And making choices that align with your personal circumstances.
Exactly. And another key takeaway is the importance of doing your own research.
Okay.
Don't just take our word for it, or anyone else's for that matter.
Right.
Dig into the companies you're considering.
Mm-hmm.
Understand their business models, their financials, and their strategies.
Okay.
Read industry reports, explore their websites, and even try their products.
It's like dating.
Right.
You wouldn't marry someone after just one date, right?
No, exactly.
You need to get to know them, understand their values, and see if you're truly compatible.
I love that analogy, right?
Yeah.
Investing should be about finding companies that you believe in.
Right.
Companies that you're proud to be a part of. And that requires more than just a cursory glance at their stock price.
So research is key.
But once you've done your homework, what's the next step?
Well, if you're feeling overwhelmed or unsure, it's always a good idea to consult with a financial advisor.
Okay.
A qualified professional can help you assess your risk tolerance, clarify your financial goals, and develop a personalized investment strategy that aligns with your needs and circumstances.
That's like having a personal trainer for your finances.
Yeah.
They can help you stay on track, make adjustments as needed.
Exactly.
And ensure you're making progress towards your goals.
Exactly. Investing doesn't have to be a solo sport.
Right.
Having a trusted advisor by your side can provide valuable guidance and peace of mind.
All right, so we've got those key takeaways. Know yourself as an investor.
Yeah.
Do your research and consider seeking professional advice.
Yeah.
But before we wrap up, I wanted to bring up one final point.
Okay.
That I think is particularly relevant to our learner audience.
Right.
Throughout this deep dive, we've been focusing on the quantitative side of things. Those PE ratios, dividend yields, and all those other financial metrics.
Mm-hmm.
But there's another layer to consider.
Right.
One that's often overlooked, but equally crucial.
You're talking about the qualitative aspects, those intangible factors that can't always be captured in a spreadsheet.
Exactly. Things like the quality of the management team, the strength of the brand, the company's culture of innovation, and their commitment to sustainability. These factors can be harder to quantify, but they can have a significant impact on a company's long-term success.
Absolutely. It's like judging a book by its cover versus reading the entire story.
Right.
The numbers tell one part of the tale, but the qualitative aspects reveal the heart and soul of a company.
So for our listeners who are ready to take that next step and delve deeper into these companies, I encourage you to go beyond the numbers.
Absolutely.
Read industry reports, explore their websites, pay attention to their social media presence, and even try their products.
Immerse yourself in their world.
Right.
Get a feel for their brand personality, their values, and their vision for the future. These insights can be invaluable in assessing whether a company is a true long-term fit for you.
It's about connecting with companies that resonate with you on a deeper level.
Yeah.
Companies that you believe in and are excited to support.
And that's what makes investing so much more than just a numbers game.
Right.
It's about aligning your capital with your values, supporting companies that are making a positive impact on the world, and building a brighter future for yourself and for generations to come.
So as we wrap up this deep dive into AbbVie, PepsiCo, and Hershey, we leave you with this final thought-provoking question.
Right.
Considering everything we've discussed today, both quantitative and qualitative, which of these companies aligns best with your investment philosophy?
We'd love to hear your thoughts.
Right.
Feel free to share your insights on our social media channels. Remember, the deep dive is all about empowering you to become a more informed and confident investor.
Until next time, keep exploring, keep learning, and keep diving deep into the fascinating world of investing.